grade 12 ABM students. Today, we will continue our discussion about analysis and interpretation of financial statements. Here are our learning targets. First, we're going to define the measurement levels, namely liquidity, solvency, efficiency, and profitability. Then, we will compute and interpret financial ratios such as current ratio, working capital, gross profit ratio, net profit ratio, receivable turnover, inventory turnover, debt to equity ratio, and the like. What is a ratio analysis? Ratio analysis expresses the relationship among selected items of financial statement data. The relationship is expressed in terms of a percentage, a rate, or a simple proportion. A financial ratio is composed of a numerator and a denominator. For example, a ratio that divides sales by assets will find the peso amount of sales generated by every peso of the asset invested. This is an important ratio because it tells us the efficiency of invested assets to create revenue. This ratio is called asset turnover. There are many ratios used in business. The ratios are used to measure the element of liquidity, solvency, profitability, and efficiency. Let us define each one by one. First, we have profitability. This refers to the company's ability to generate earnings. It is one of the most important goals of businesses. Then we have here profitability ratio, which measures the ability of the company to generate income from the use of its assets and invested capital as well as control its costs. This ratio assesses the efficiency of the business in generating from its assets. Let us discuss the profitability ratios. First, we have the gross profit margin or the gross profit ratio. This reports the peso value of the gross profit earned for every peso of sales. We can infer the average pricing policy from the gross profit margin. The formula for this is gross profit divided by net sales. This answers the questions: for every peso sale, the business will generate how much peso for its gross profit. Next item is the operating income ratio. This expresses operating income as a percentage of sales. It measures the percentage of profit earned from each peso of sales in the company's core business operations. The formula is operating income divided by net sales. Let's say that the value is 11%. So it means that for every 1 peso net sale, the business generates 0.11 pesos for its operating income. Next, we have the net profit margin or the ratio of return on sales. Net profit ratio relates the peso value of the net income earned to every peso of sales. This shows how much profit will go to the owner for every peso of sales made. So the formula is net income divided by net sales. So let's say that the result for this one is 11% also. So it means that for every 1 peso net sale, the business generates 0.11 peso net income. We also have here the return on assets or the ROA. This measures the peso value of income generated by employing the company's assets. It is viewed as an interest rate or a form of yield on asset investment. The numerator here is the net income, while the denominator for the formula is the average assets. The value of average assets is computed as beginning balance less ending balance divided by 2. Let's say that the computed value is 7%. So it means that the company generates 0.07 net income from the use of 1 peso asset. The last ratio for profitability is the return on equity. This measures the return or the net income generated by the owner's capital invested in the business. Similar to ROA, the denominator of ROE may also be total equity or the average equity. So let's say that the value is 7%. So it means that for every peso or for every 1 peso capital, the company generates 0.7 net income from its operations. Aside from profitability, we also have here the efficiency. How can we say that the company is efficient? Efficiency refers to a company's ability to be efficient in its operations. Specifically, it refers to the speed with which various current accounts are converted into sales and ultimately cash. Operational efficiency ratio measures the ability of the company to utilize its assets. Operational efficiency is measured based on the company's ability to generate sales from the utilization of its assets, as a whole or individually. The turnover ratios are primarily used to measure operational efficiency. The first turnover ratio is the asset turnover. This measures the peso value of sales generated for every peso of the company's assets. The higher the turnover, the more efficient the company is in using its assets. The formula is net sales over average assets. The next one is the fixed asset turnover. This is the indicator of the efficiency of fixed assets in generating sales. So for the formula, we have net sales divided by average fixed assets. Next, we have the inventory turnover. Inventory turnover is measured based on cost of goods sold and not on sales. As such, both the numerator and denominator of this ratio are measured at cost. It is an indicator of how fast the company can sell the inventory. So for the formula, we have cost of goods sold over average inventory. Next, we have the days in inventory. An alternative to inventory turnover is days in inventory. This measures the number of days from acquisition to sale. So, it tells us in how many days does the company sell its inventory. So, for the formula, we have 365 divided by inventory turnover. Next, we have the accounts receivables turnover. This measures the number of times the company was able to collect on its average accounts receivable during the year. So the formula is net sales divided by average accounts receivable. Then, we have the days in accounts receivable. An alternative to accounts receivable turnover is days in account receivable. This measures the company's collection period, which is the number of days from sale to collection. For the formula, we have 365 divided by accounts receivable turnover. It answered the question, how many days to collect account receivables? Now, let us proceed to financial health ratios. These look into the company's solvency and liquidity ratios. A while ago, we have the profitability and efficiency. Now, we will discuss solvency and liquidity. Solvency refers to the company's capacity to pay their long-term liabilities. On the other hand, liquidity intends to measure the company's ability to pay the debts that are coming due, or the short-term debt. We have 4 solvency ratio. These are the debt ratio, equity ratio, debt to equity ratio, and the interest coverage ratio. For the first one, we have debt ratio, which indicates the percentage of the company's assets that are financed by debt. A high debt to asset ratio implies a high level of debt. So it is computed through total liability over total assets. Next, we have the equity ratio, which indicates the percentage of the company's assets that are financed by capital. A high equity to asset ratio implies a high level of capital. So it is computed by total equity divided by total assets. Next, we have the debt to equity ratio. This indicates the company's reliance to debt or liability as a source of financing relative to equity. A high ratio suggests a high level of debt that may result in high interest expense. This is computed by total liabilities divided by total equity. Last one, we have the interest coverage ratio, which measures the company's ability to cover the interest expense on its liability with its operating income. Creditors prefer a high coverage ratio to give them protection that interest due them can be paid. This is computed by operating income divided by interest expense. We only have here 2 liquidity ratio. First one is the current ratio, and then the next one is the quick ratio. Current ratio is used to evaluate the company's liquidity. It seeks to measure whether there are sufficient current assets to pay for current liabilities. Creditors normally prefer a current ratio of 2. The formula, current assets divided by current liabilities. For the quick ratio, this is a stricter measure of liquidity. It does not consider all the current assets, only those that are easier to liquidate, such as cash and accounts receivables that are referred to as quick assets. For the formula of quick assets, it is equal to current assets less inventory. And for the formula for the quick ratio, we have quick assets divided by current liabilities. Here are the sum of the uses of financial ratios. Financial analysis is used to evaluate the company's actual performance against industry average. Comparing actual performance to industry average and to specific competitor is called benchmarking. Financial ratio can be used for forecasting. Financial ratios are widely used by potential creditors and investors. And financial statement analysis is used to support business decisions that will have an effect on future periods. Here are some limitations of financial statement analysis. Historical performance based on financial analysis may provide an indication but will not ensure future performance. A good financial statement analysis will be worthless if the financial statements are erroneous or fraudulent. Next, some financial statements are not directly comparable because of difference on accounting treatment of like transactions. Thank you for watching this video. Please make sure to attend the Zoom meeting class for the enrichment part of our discussion. Thank you and God bless you all.